Top tax breaks for homeowners. If you own a home or are thinking of buying one, you've probably heard about tax breaks for homeowners. Buying a home is typically the largest investment that everyday ordinary folks make in their lifetime. A little planning goes a long way toward ensuring that you get the most value from homeownership. One way to create value is to reduce expenses, and tax deductions can help cut into your overhead. When it comes to tax deductions, there are various benefits instituted by the government, aimed at encouraging more people to own homes. You can take advantage of these tax advantages by comparing your standard and itemized tax deductions and settling on the scenario with the highest tax benefits. Here are some itemizations that can help you make that determination. The deductions on mortgage interest are among the biggest tax benefits you can get on your home. Mortgage interest refers to any interest paid on a debt secured by the primary residence or second home. Deductions are not applicable for interest paid on a personal loan. Just home loans. Interest deductions can be taken up to $1 million of the loan used to acquire or improve the home. At the beginning of each year, your lender should provide you with Form 1098, detailing the total amount of interest you paid in the previous year. Check the settlement sheet to ensure that Form 1098 includes the interest you paid from when you closed on the home to the last day of that month. Mortgage insurance premiums refer to extra fees paid to protect the lender should a borrower default on a home loan. These premiums are paid by buyers who make a down payment of less than 20% of the loan amount. Mortgage insurance premium deductions can be made on home mortgages issued from 2007 onward. According to the IRS, if the adjusted gross income is indicated on Form 1040 is more than $100,000 or $50,000 if you are married and filing separately, the amount of deductible mortgage insurance is reduced. The statement on the mortgage insurance premiums is available in Form 1098. Mortgage points are fees paid directly to the lender, broker at closing in exchange for a lower interest rate. Points are deductible as interest if the loan is secured by the home and the amount you deposited at the closing as down payment is equal to the points. It does not matter whether you or the seller paid the points, you are entitled to the deductions as long as you meet the minimum requirements. You will be able to deduct your points in the same year you pay them if you itemize them on Schedule A of IRS Form 1040. If you have made home improvements, keep the receipts and other documents safely. Those expenses become tax breaks when you decide to sell your home. Current. The law allows you to add all the home improvement expenses on the purchase price of your home, thus reducing the capital gains taxable amount. As a first-time home buyer, you can take advantage of the IRA penalty-free withdrawal for your down payment. IRA rules allow you to withdraw up to $10,000 to help build or acquire a home for yourself or loved ones. The money must, however, be used to build or buy a first home within 120 days from the time it's withdrawn. You can be considered a first-time buyer as long as you have not owned a home in the last 3 years. However, even though not penalized, the IRA withdrawals are subject to federal and state tax. It is therefore not advisable to tap into this account unless there is no other option. Alternatively, you can withdraw your contribution to a Roth IRA account, which is usually penalty-free and tax-free. The best thing about a Roth is that after 5 years, you can withdraw up to $10,000 of earnings for first home purchase without incurring any taxes or penalties. Another tax break for homeowners is in the capital gains. A single person can sell a home for a profit of $250,000 and not pay a dime in taxes. Likewise, a married couple can sell a home and make a profit of $500,000 and still not pay anything in taxes. However, some conditions apply. First, the home on sale must be your principal residence, and you must have lived in it for 2 of the 5 years before you sell it. You can earn an additional tax break on your primary residence through energy-saving home improvement practices. For instance, you can get credit for up to 10% of the cost of installing things like insulation systems, qualifying central air conditioners, energy-efficient heat pumps, furnaces, water boilers and water heaters. The credit can extend up to 30% of the cost for more expensive energy-efficient equipment. When your home appreciates in value, you can use the equity as security to borrow more money. Like a regular mortgage interest, the interest of home equity loans is tax deductible. Federal tax law permits mortgage interest deductions on up to $100,000 in home equity loan. The best place to check whether you are overpaying or underpaying your taxes is the W-4 form you filed with your employer. If you are always finding out that you have underpaid your taxes, check whether you are getting the mortgage interest and other deductions as required. There are numerous ways you can genuinely claim deductions on your taxes. For instance, you can claim a deduction if you have a side job, a side business, or you do some freelancing. Ensure you adjust your W-4 withholding by following the instructions on the IRS website. The journey to paying down your debt can be challenging in the best of times. It can be even more complicated when you're balancing the effects of a global recession. Many Americans are facing immediate financial uncertainty from losing their jobs or being underemployed. The economic repercussions of this pandemic recession will be felt for years to come. Although becoming debt-free might not be your top priority during this difficult phase, you should still take steps to maximize your money. The first on this list of debt consolidation tips is asking your creditors to lower your interest rates. Many borrowers don't realize they can contact their existing credit card providers at any time to request a lower interest rate. This often overlooked tactic is a quick and easy way to reduce your debt burden. And it may result in a permanent or temporary, e.g., 12 months, interest rate reduction. Creditors are more likely to say yes if you have a history of on-time payments or if your credit score has recently increased. Even if that's not the case, the worst thing your creditor can do is say no. If you aren't successful in lowering your interest rate, don't hesitate to ask again after a few months or after receiving lower offers from competitors. Credit card providers can issue reductions at their discretion, but it's up to you to initiate the request. High-interest loans and credit cards can prevent you from climbing out of debt. Although you're hard at work making payments, interest charges are continuously accruing. This interest can quickly eat away at your monthly payment instead of chipping away at the principal balance. To help make some headway in repaying your debt, see if you can pause payments on your lower interest loans. Then, devote those funds to your higher interest debt. This lets you eliminate your balance faster and save you from unnecessary interest charges. Options for loan deferment vary by lender. In some cases, lenders might offer an interest-free deferment. Other lenders might continue charging interest on your loan during deferment. Contact your lender to determine if deferment is available and for how long. Even a pause of 2 to 3 months can help you put a noticeable dent in your high-interest debt. You can quickly reduce your overall interest by taking advantage of low or 0% APR balance transfer credit cards. By transferring your existing balance from a higher interest card, you can save money and pay down your balance quicker. A low interest rate or promotional offer, however, might come with an additional cost in the form of a balance transfer fee. For example, a creditor might offer 18 months of 0% APR when transferring a balance from another card. This perk typically comes with a 3-5% balance transfer fee that's calculated based on the transfer amount. In this scenario, you could tack on up to $300 to $500 in transfer fees if you transfer an existing $10,000 balance to a new card. You'll need to weigh your potential savings versus the transfer fee to determine if this is a good debt consolidation strategy. Additionally, your new card might have transfer limits or a short introductory period before a higher interest rate kicks in on any remaining balance. Be sure to read the fine print and stick to your repayment strategy, so it doesn't end up costing you more in the end. Whether it's your mortgage, student loans, auto, or other consumer debt, you might find a lower interest rate by refinancing your loan. Refinancing is one of the most helpful debt consolidation tips you should know. Refinancing replaces your existing loan with a new loan, usually with a lower interest rate or better terms. You might qualify for a better rate than when you originally took out the loan if your credit score has since improved or if consumer loan rates have dropped. Mortgage and student loan refinancing rates are at record lows since this pandemic began, which is a small silver lining in otherwise tragic health and economic crisis. The bottom line is if you can find a lower interest rate for any of your loans, take action. Remember, there might be associated refinancing fees or closing costs depending on the type of loan and lender. In some cases, you can benefit from modifying an existing loan instead of refinancing it into a new loan, particularly if you need immediate relief due to financial hardship. Depending on the type of loan, the refinancing process can take months. as is the case with some mortgage refinancing options. Loan modifications, however, can be processed in a short period. Loan modification can make your payment more manageable by reducing your interest rate or lowering your monthly payment. It can also extend your loan terms, which typically costs you more money in the long run. Contact your lender to explore loan modification opportunities. Always make sure you fully understand the terms and structure of your modified loan before moving forward. If you have high interest debt, you may be able to consolidate multiple balances into one low interest loan. This can save you on interest fees, but it can also streamline your payments into one due date, which can prevent missed or late payments. It's best to grab quotes from at least 3 lenders anytime you're consolidating or refinancing your debt. By comparing multiple offers, you're getting the best current rate since lenders are competing for your business. I recommend shopping around for all types of loans, especially for better student loan rates. Student loan debt, totaling more than $1.64 trillion in both federal and private student loans, surpasses all other forms of debt in the U.S., apart from housing debt. Because of this, there are plenty of opportunities to refinance or consolidate your student loans. If you already have private student loans, you should be shopping around for better interest rates at least once per year. Lowering your interest rate is the priority. But also compare origination fees, repayment terms, and any available cashback offers to pay down your debt further. If you have federal student loans, the decision gets more complicated. Depending on your financial situation and career goals, it might be more advantageous to keep your existing federal student loans due to their various protections, e.g., deferment and forbearance, flexible income-driven repayment plans, and available forgiveness programs. Before consolidating a large amount of debt, take steps to improve your credit score. The higher your credit score, the better interest rates you'll be offered. These actions can help lower your credit utilization rate while maintaining your credit history length. Both are important factors in determining your credit score. Another often overlooked debt consolidation tip is canceling small credit cards. If you use a debt management program or a debt consolidation loan, you might be required to close certain credit card accounts as part of the agreement. This gives the lender more confidence that you won't run up new balances and increases the likelihood that you'll repay the debt. Even if you choose a different method of consolidation, it's a good idea to cancel your smaller or newer credit cards by choice, or cut them up, to discourage you from using them. With endless opportunities to borrow money, payments can slip through the cracks. Check your credit report periodically to ensure you haven't forgotten about a small loan or debt. For example, you may find that a medical bill has been sent to collections without ever physically receiving a notice because it was sent to a previous or incorrect address. Perhaps you simply forgot about a loan that has an old email on file. You could be in default without realizing it. You're entitled to one free copy of your credit report from each of the major credit reporting companies, Equifax, Experian, and TransUnion, every 12 months. By keeping an eye on your credit report, you can head off any surprises and actively resolve any financial issues that arise. An often overlooked debt consolidation tip is signing up for a budget tracking service. It's easy to become detached from your money when you're swiping your credit card instead of paying with cash. This psychological separation leads to overspending and more debt. Free and paid budgeting tools can help you reconnect with your finances and keep you accountable along your journey. Platforms like Mint or You Need a Budget (YNAB) can help track your expenses and give you a big picture view of your finances. There are many free and paid budgeting tools out there, so find one that matches your financial needs and goals. Although these debt consolidation tips can help you save on interest and streamline your debt payoff strategy, it's only one piece of the financial puzzle. If you're spending more than you're earning, you'll continue to get trapped in the debt cycle. Start by setting a realistic budget, which might include significant lifestyle changes. You might need to trim down some of your expenses or find a way to bring in additional income. By relying less on credit to make ends meet, you'll reduce the likelihood of repeating the debt cycle. Text source: lifehack.org.